Hi, this is Alan Lenahan from FEG, and I'm joined by Catherine Maurer. Thank you for joining us for the May 2020 update for the Community Foundation for the Fox Valley region. May was another good month for markets, continuing their recovery from the March 2020 lows. The global equity markets were up 4.3% during the month. U.S. fixed income had another solid month, up 0.5%. Real assets had a 2.6% return for the month, and the hedge fund benchmark was up 1.4%. Year to date, that brings us to only down 9.2% for the global equity markets, which is quite a recovery from March timeframe. Fixed income during a flight to quality year has had a solid 5.5% return. Real assets still struggling, minus 18.9%, even though they've recovered well in April and May. Still a difficult year to date for real assets. And the hedge fund strategies have marginally underperformed fixed income, in between fixed income and equities, about where we expect. Now, year to date, if you look underneath these headline numbers, the trends continued in May that we've seen in April, as well as, frankly, most of the last decade. And that is U.S. equity markets continuing to outperform international developed, with the S&P up 4.8% during the month relative to the MSCI EAFE index up 4.4%. That's developed international stocks, and emerging markets trailing at 0.8%. And you can see year to date, those numbers are even magnified, with the U.S. equity markets down only 5%, the international equity markets down 14.3%, and emerging markets down 16%. The other trend that's continued in May is the growth versus value. So growth stocks year to date are actually in positive territory. As difficult as this economic environment has been, growth stocks are up 5.2%, while value stocks are down 15.7%. So quite a dispersion between growth and value so far this year. There's a couple key narratives that the market is keying off of over the last few months, and likely to continue to key off of as we move forward. First is intervention, and that is policies by the Federal Reserve as well as the U.S. government on fiscal stimulus that have buoyed markets in a period of the second narrative, which is an economic recession very rapidly brought on by the COVID-19 crisis. So it's a battle between fiscal and monetary stimulus and economic weakness. The economic weakness story is driving a lot of volatility we've seen in the most recent weeks in June, as the reemergence or growth of the virus has caused a lot of concern and resulted in a little bit of a sell-off in the equity market most recently. A third narrative will develop, and we're yet to see that really take hold, but that is the 2020 election. As we move forward and get closer to November, the stories and the likely outcome of that election will start to move markets pretty dramatically.
As Alan just discussed, May was a good month across the board for the markets. You'll see this reflected in the portfolio performance. Looking first at the endowment and long-term portfolios, performance for May was 4% and 3.6% respectively. The two portfolios have the same broad asset allocation strategy, but they do differ in their implementation, which is why you see a little bit of difference between the performance. The endowment uses predominantly active strategies, while the long-term portfolio uses predominantly passive strategies. Further, the endowment invests into perpetuity and therefore can embrace longer-term lockups and invest in strategies such as private capital. And as we've discussed in our previous updates, both of these portfolios embrace an equity bias. That equity bias results in higher short-term volatility. So it's not surprising that the returns for May are higher in both of these portfolios than they are for the intermediate-term portfolio, the short-term portfolio, which were at 2.2% and 0.1% respectively. Conversely, the higher short-term volatility is also reflected in the year-to-date performance. Both May and April were good months, and that helped mute some of the sharp negative returns that we witnessed during the first quarter. But year-to-date returns are still negative for all but the short-term portfolio. We have put a lot of thought into how we can further offset those negative returns of the first quarter, and Alan can share a few ideas right now as to what we're thinking.
Thanks, Catherine. It's been nice to talk about a couple good months here in our initial updates virtually on the portfolio, but we're still in the midst of a transition to new strategic targets and the allocations that FEG is bringing to the table. However, one holding in the portfolio, Westwood Global Investments, an emerging markets manager that was previously in the portfolio, is a manager that we think highly of and utilize across many of our client portfolios. The adjustment to the portfolio, however, has been to moderately reduce the exposure, as the target allocation to emerging markets was higher than FEG would advise for a client. So we've reduced the exposure, but at the same time, utilizing our Access platform, we were able to reduce the fee paid to Westwood from 115 basis points, or 1.15%, to 90 basis points, due to the scale and leverage we bring via the platform. We were also able to redeem capital and avoid the 10 basis point charge that Westwood generally levies on redemptions. So the scale and structure of the FEG relationship was able to right-size this investment with a good manager at a lower fee and avoiding cost. We will continue to implement changes to the portfolio such as this to bring it in line with FEG's expectations and design. Thank you very much for joining us for this brief update on May. We hope to have another solid month coming up in June, and we'll speak to you then. Thank you.